Welcome back, everyone. So for this chapter, this final chapter, we are going to talk about shareholders' equity, and along with that, we have to talk about corporations a bit, which we have not done so far. As I mentioned in a couple of the earlier videos, what we did is we worked our way down the balance sheet, right? So we covered assets, we covered liabilities, and now we're looking at that stockholders' equity section. But before we can talk about that in any real meaningful way, let's talk about corporations a little bit first. All right, so let's talk some of the advantages of being a corporation. Limited liability. That is probably your number one biggest advantage. The idea there is that if you form a corporation, it's kind of like called a corporate shield. Let me give you an example. If I were to have my donut business, right, Anne Marie's Donuts, and let's say that my donuts made people sick through, accident, right? Not intentional, that's criminal, that's different. But let's say I accidentally, had an ingredient that made somebody sick. If that was the case, that person can sue Anne Marie's Donuts, the business, but they can't sue Anne Marie Anderson, the individual, okay? Because the idea is that they can only sue the corporation. The liability is limited for me, the owner. I can only lose what I've put into the corporation. The corporation could be sued and maybe it can go under because, it was sued for everything it had. Doesn't matter. The point is, though, is that they can't come after me, the individual, the primary shareholder. The most I could lose as an investor in any business is the capital that I've put in. My liability is limited. My assets personally are protected. Okay, so that's the biggest advantage of incorporating your business. Another thing that's good about an advantage of a corporation is the ability to raise capital. If you think about it, right, you've got your golden equation there, your assets equal liabilities plus shareholders' equity. You can do things like you can take out loans on the business, you can issue bonds, right? Like a regular person just having a business not incorporated can issue bonds. You can also issue stock in the corporation as a way to fundraise, to expand operations. Okay, so it's a little bit easier to raise capital if you're incorporated. Additionally, you have a continuous life. If I had my donut business and I passed away, the business could still continue because somebody else maybe would own it, maybe it would pass along to my heirs. The idea is that just because the original owner may have died doesn't mean the corporation goes away. Just, it can just pass along. Think about things like Kellogg's and whatnot, right? The original founders of those have been gone for quite some time, but the business, the corporation continues. It's also very easy to transfer ownership. Sell the stock, right? If I no longer want to be the owner of a business, I would just sell my stock to someone. I mean, it's a little bit more complicated than that, but really, it's a much easier transfer of ownership than any other business. Some of the disadvantages. Let's look at some of the disadvantages now. The single biggest disadvantage, I would say, is double taxation. All right, you may have heard of that. Let me give you some really simple numbers to try to kind of explain how double taxation works. Let's say you had a profit. Your business had a profit of $100,000, your corporation. Well, then we have to pay corporate tax. We have to pay 21%. And actually, it's back up now. It went down to 21%. I need to revise these, but it's back up a bit higher than the 21% now. But let's just play along with the numbers. So you had $100,000. You had to pay corporate tax on that $100,000. So really you netted $79,000 after taxes. Well, here's what happens. Let's say the corporation then decides to pay dividends to its owners, right? Or, the owners draw money out of the business. If that's the case, right, the dividends go to the owners, the investors, and then the investors would then pay tax on their tax return. So they would pay tax on those dividends. So that same $100,000 got taxed not only at the corporate level, but if it passed along in dividends to the owners pay it on their tax returns too. Double taxation. Which is why things like LLCs and S-corps are much more popular, because the taxes actually flow through the tax return, through the individual tax return, and you only pay taxes once that way. But at the corporate level, and most large businesses are going to be corporations, regular traditional C corporations, they're going to pay double taxes. There's obviously a lot more regulation, right? If you're a public company, you're required to file quarterly statements, quarterly financial statements, and then file an annual financial statement, right? So there's a lot more, and of course the SEC is watching all those things. There's a lot of government regulation. And it's expensive to start up a corporation, right? You've got to deal with all the legal things that are involved with starting up a corporation and so on. And we'll talk about those in the next slide a little bit, but high startup costs in general. Ownership being separate from management. We're actually going to talk about the hierarchy. So let me get to the next slide that will explain that last statement a little bit better. The hierarchy. Okay, so if you are a stockholder, technically you own the corporation, right? If I want to own some of Disney World, right, I just buy a share of Disney stock and I am then a stockholder / owner. It doesn't mean that I can go and start making rules at Disney World, right? Because what the stockholders actually do, and they have the right to do, is they vote. And they vote in a board of directors. And those are going to be, it's almost like an elected official, right? So the same as we do with government, right? We elect in officials that have the same values that we do. So a stockholder would then try to elect a board of directors that have the same values that they do. And that board of directors are then the ones who then hire the officers, the CEOs, the CIOs, the CFOs, all of the CTOs, and all of those kinds of things, right? They hire the people that will best run the company. And those people then are the ones who hire the employees and deal with the day-to-day business. So the thing is, owners being separate from management, just because I'm an owner, like I own a share of Disney World, does not mean I have any say in who gets hired or, how the business is run. What my only job is to do is to elect a board of directors member that best represents my interests. Okay. When you do form a corporation, I mentioned there's a lot of startup involved, right? So you have to apply with the state. Interesting little fact, the state that has the most number of corporations incorporated within it, Delaware. There's a bunch of reasons, but really Delaware, has to make its money somehow. It's a tiny little state. So it makes a lot of its money by having people incorporate there. They make the process really easy for businesses to incorporate. They've got their own separate judicial system, designated for corporations. It's a very corporate friendly state. So if you're going to incorporate anywhere and pay the fees, even if you don't operate out of Delaware, you still would apply in Delaware just because it's got the lowest cost, ease of use, and ease of creation, I guess, of corporation creation. But yeah, so Delaware is the number one. Okay, so you apply with the state. You have a charter. The charter is going to list what your name of your business is, what the purpose is, how many shares you're going to have authorized, and so on. Within the charter, you're going to have the bylaws that are pretty much like who are the officers, what are the officers' roles going to be, what are the powers of the board of directors, what are the rights of the individual shareholders. And then from there, you're going to start issuing stock, right? And the stock could be public, it could be private. It doesn't have to be a public company to issue stock. Private companies have that as well. Okay, so imagine all of the costs and fees and all of those things and all the regulations and all the startup involved here. Quite costly and a lot involved. If you were, say, a sole proprietorship, and I think I've used this example before, you wanted to start selling cupcakes out of the trunk of your car, you could do so. Of course, then you do not have limited liability, so if somebody gets sick, they can come after you personally. All right, so the corporation, forming a corporation, again, forms that shield around you. Okay. Oh, sorry, SEC approval. There you go. You need SEC approval for a public company to issue stock. All right, so we are talking about corporations, so now we're going to talk about stockholders' equity, starting to move into that part of the conversation. We did already talk about assets, we've talked about liabilities, and we've talked about stockholders' equity, but we're going to talk about it in more detail. So the categories within stockholders' equity, you've got paid-in capital, right? That is money being contributed into the business, and the business then turns around and gives the owner common stock, right? Think about it, paying in capital into the business. Or retained earnings. Again, earnings, the money the business has made and held on to. So you have two different categories of stockholders' equity. What has been just paid in by people who want ownership, and what has been earned by the company. Okay, so the categories you're going to see in retained earnings, right? You've got net income. That lives in retained earnings. And from that net income, of course, subtract any dividends that then gets pulled out of the business. If you remember we talked about this in the closing entries, right? The net income gets closed into retained earnings, and then dividends gets closed into retained earnings. So the net of these two is the amount of money you made, your net income, that you've held on to, right? Minus that dividends. Now in the paid in capital section, this is where your stock is. Now we've always talked about common stock. That is the normal class of stock in any business, the regular everyday class of stock. Well, there's one other that you'll hear of and we'll talk about today is preferred stock. Not every business has preferred stock, but some of the examples we're going to do today do have preferred stock. And we'll talk about the differences on the next slide. Okay, I'm going to pause it here and we'll continue on.